welcome all of you to our Tax Summit of today. My name is Barbara Henson. I will introduce the topics of today, and then I will hand over to my team, which I will introduce to you later. As usual, we will have a Q&A session at the end of this session. We have foreseen enough time. We have around 30 minutes. So whenever you have questions during the sessions, please use the Q&A button on the right-hand side of your screen and ask the questions. If possible, ask the questions to all panelists, which will allow us to answer them and to make sure that we don't miss anything. Please also note that this session is recorded. We will provide you with the tape or the recordings in the next couple of days. And last but not least, at the end of this presentation, you will receive a short survey. We would be really glad if you could take give us the feedback, and we will, of course, consider it for future sessions. There is a lot happening in the tax landscape at the moment. Internationally, the BEPS action plans are almost done, or a lot of countries are finalizing the last implementation of the last actions. But the OECD is already one step forward and has launched BEPS 2.0. BEPS 2.0 has two pillars. One pillar is addressing the tax issues of the global digital economy, and BEPS and the pillar 2 of BEPS 2.0 is introducing a global minimum tax. We will come to that later. In the tax departments of big multinational companies, we see a big shift from that the focus is no longer to have a low effective tax rate at any price. It's much more to be transparent and to be compliant. And also in the region, there was a lot of movement. When it comes to VAT, we have seen that the VAT journey of the GCC countries continues. Oman has introduced VAT, and Saudi and UAE have increased their VAT rate substantially. And also when it comes to corporate income tax, we have seen that countries with companies who had no corporate income tax systems before, they are currently introducing corporate income tax, or are at least thinking about that. Most recently, UAE, who has announced 9% corporate income tax starting from mid-2023. And why this is 9%? Later in this presentation, Anand will explain that it's not by coincidence. So this 9% have a good reason. Also, when we see at Qatar, there was a lot happening. So Qatar went through the first cycle of transfer pricing reporting last year, and also economic substance regulations have been introduced. Apologize, so VAT is still on the table in Qatar, and even a complete change of the corporate income tax system is no longer impossible. So for this session, we tried to talk about all of these ongoing changes and make sure that we address the ones who are relevant for companies having operations in Qatar. This has led us to the following agenda. At the beginning, Imran will lead you through the current tax development in Qatar. He will then hand over to Uma, who will talk about the lessons learned from the first transfer pricing filings, and also talk about some international aspects which are relevant for you. We'll then give you a short update on VAT, what is the current status and our current understanding. Then we will talk about the economic substance regulations, which has been recently introduced in Qatar, and also BEPS 2.0. As I mentioned before, we will have enough time to address the questions in the Q&A session. That I hand over to Imran, which will lead us to the current tax developments.
Thank you, Barbara. Thank you, everyone, for attending our annual tax summit. So today I will be covering the recent tax development in Qatar. I will be discussing some of those topics in at a high level before my colleagues will be discussing some of those topics and other international developments in detail. First of all, as you know, we are approaching FY 2021 tax filing deadline, which is scheduled to be 30th April 2022. The question will be in many people's mind whether there will be an extension announced for the GTA or not. So far, in communicate to you that KPMG, along with the other big three firms, has requested General Tax Authority for a clarification and a request for an extension. The general extension of 30th June 2022. However, there has been no confirmation from the General Tax Authority. We have seen, in addition to it, that the General Tax Authority publishing social media posts as well as sending text messages to companies reminding for the deadline that is to file their to be ready for their filing deadline by 30th April. Is not extended so far, so companies should be ready for 30th April 2022. However, those companies which know at this stage that they will be delayed, their tax filing will be delayed for various reasons, they have the option to request for a specific extension to the General Tax Authority. Now, this can be done through the RIBA, and the last day for filing an extension is 28th Feb 2022. We can also communicate to you or share our experience that we have seen that often the General Tax Authority is not very positive about those requests. So first of all, our main recommendation would be to get ready for 30th April 2022 tax filing, given that there is no certainty as of this stage. The second topic is about the RIBA. As you know, that the RIBA was a major change. It changed from the old traditional manual system to and more face-to-face discussion to more automated self-compliance tool. The RIBA was a major change. It was not an easy change. So there were issues at the start of the RIBA implementation. However, we have seen that the General Tax Authority is continuously trying to improve and create efficiencies in the system. Some of those features which are recently introduced, I have highlighted here is the ability of the companies to upload depreciation schedule. That was a major challenge last year while filing tax return, because companies have to input each and every asset in their tax in the depreciation schedule, which was in the RIBA. That was a very time-consuming process. Also, there are some other features which are made available, like you can file objections and appeal through the RIBA. You can request and obtain tax residency certificate, and also request for no objection certificate through the RIBA. What we can see that there have been improvements, and we continue to see improvements in the RIBA system. Before going to the third topic, the Oman Tax Treaty, I can share with you a brief background. There was already a treaty between the GCC countries in 1989 tax treaty, which provides the equal tax treatment to GCC citizens. However, that is a very old treaty, and apart from providing the equal tax treatment, it doesn't necessarily resolve the issue of double taxation. Therefore, there was a necessity to have a bilateral treaty. We can also see that necessity was further enhanced by introduction of a corporate tax system in other GCC countries like UAE announced it now, and we expect that Bahrain will follow it very soon. So there, like as I mentioned, there has been a kind of a shift towards having a double tax treaty. First of those treaties we have seen between Saudi Arabia and UAE, and now another key tax treaty is signed between Qatar and Oman. We understand that there is a huge volume of trade between Qatar and Oman, so that treaty is really significant for businesses investing in, for example, Qatari companies investing in Oman. The Qatari companies who are investing in Oman, they will be able to benefit from a 0% or exemption from withholding tax on dividend and interest upon meeting the condition. Otherwise, that tax rate would have been 10%. Also, the companies which are investing can also benefit from the reduced withholding tax rate on royalties and technical fees. So now moving to another topic. As Barbara was mentioning to you about the BEPS 1.0, we call it, the initial implementation, that process is almost completed. We have seen one of the steps, which was the implementation of BEPS Section 14, which is the dispute resolution mechanism and availability and access to MAP. Qatar, as part of inclusive framework member country, has introduced or had made available access to MAP. They have issued guidelines, rules, and also the feature is available now in the RIBA. Just very shortly, what is the mutual agreement procedure? Mutual agreement procedure is where two tax authorities work together or like cooperate with each other to find a solution to a double taxation dispute which might be affecting the taxpayer. That process is only in force when there is a double tax treaty between the two countries. So with that, with the accessibility of MAP, that also leaves the possibility that there might be other companies which might still be affected and they want more tax certainty also. So that is usually resolved by advanced ruling system, which is a kind of a more like a unilateral. Qatar doesn't have advanced ruling system, as most of you will be aware of. However, what we have seen recently, National Tax Authority issuing clarification to some companies that how their taxation should work. A very specific cases recently has been in the power sector, where the General Tax Authority has confirmed the tax position that how the taxation for power sector should work. We hope and we expect that the General Tax Authority will continue with this trend and will be issuing more clarification, because it provides a tax to the taxpayer, which is really beneficial. In the final topic today, I am covering at a very high level again, given the time limits, the tax dispute and litigation. We have seen the disputes with the taxpayers and the General Tax Authority increasing over the last 4 or 5 years or so. So first of those, I have highlighted few areas where the disputes are very common. One is the board of directors fees and management remuneration. We have seen the General Tax Authority is consistently adding board of directors fees and management remuneration. So now this is being, okay, prior to these years are mostly prior to when the transfer regulations were issued. However, the General Tax Authority disallowance for those fees in those years was without any transfer pricing study. We hope that with the introduction of a TP, the General Tax Authority will take into consideration the TP regulation while adjusting or adding back those management remuneration. The second topic the second the dispute which I will be talking is the statute is around the statute of limitation. As you know that the General Tax Authority has a huge backlog in the past. They try to clear that backlog in the last 2 to 3 years. So during that process, a lot of old years have been assessed, which were beyond 5 years quite often. So this has resulted into a situation where the taxpayer were arguing or challenging the GTA, the right to assessment, that those years are time barred by legislation. What is the good news here, that the appeal committee is often deciding in favor of the taxpayers, where it can be proven that the statute of limitation or the time barred period clearly applies and those years were time barred. So a more favorable appeal decisions are issued recently. Another dispute or another scrutiny area with the tax authority is the Qatari or GCC ownership. So they are looking into it whether the companies are actually owned by Qatari national or a GCC citizen, and in some cases where whether the residency requirement needs to be fulfilled, whether those requirements are in essence or in substance fulfilled. I will not go further into detail of this topic, given the time limits. Another issue where or another area where the tax authority has been is focusing quite a lot is withholding tax. And prior to 2018, when the rule was that the withholding tax was applicable where the services were performed wholly or partly in Qatar, in that regard, the General Tax Authority now is critically reviewing or scrutinizing the company's position, where they have took the position that services were rendered abroad. The General Tax Authority is expecting companies to prove that with the documentation such as invoices, contracts, and other underlying documents that those services were actually rendered abroad. The last topic is the dispute is often the GTA is scrutinizing the intercompany charges from deductibility perspective. So this is an area which is very closely linked with the transfer pricing, which we see a positive development that the tax authority is while scrutinizing those areas are also looking at the transfer pricing. With that, I would hand over to my colleague Uma, who will be taking you further with the recent TP changes and how these are and the key lesson learned which we in the last 1 year. Thank you, everyone. And over to you, Uma.
Thank you, Imran, and hello, everyone. So let's talk about transfer pricing. So the topics that we have covered for today are 4 topics. If you can go to the topic listing, it would be the first 2 topics are focused on compliance and documentation, whereas the next 2 topics are more on some international developments which could be relevant to all of you. So to start with compliance, let's focus on the submission and the filing timelines. As Imran has already explained that this year we are not expecting to have any extensions of deadlines, and that will equally apply to transfer pricing compliance as well. So accordingly, the TP declarations will have to be filed with the tax returns. So entities with year ending December will have to file their transfer pricing declarations by 30th April. And for entities with different year end, the transfer pricing declarations will be filed from 4 months from the end of the tax year along with the tax return. So when we look at master file, local file, the difference over here is that the President's resolution has specified 30th June as the deadline for submission of master file and local file. So it will be quite obvious to assume that the December year-end entities will have to file a master file and local file by 30th June. Having said that, it gets a little tricky when we talk about entities with different year-end. The reason being that the RIBA is programmed in a way that it gives you 30 additional days from the date of filing the tax return to file the master file and local file. So let's assume an entity with a March year end where the deadline to file the tax return is 31st July. Now this entity actually files it for time, say on 25th July. Then the RIBA will give you a timeline until 24th August to submit the master file and local file. So it is a little disconnected here when it comes to different year ends or entities who have been granted extensions to file the tax return. So it's very important that we keep a track of these deadlines and work backwards from there. Now let's look at the documentation. What can we do with the documentation? So last year, of course, was the first year of implementation of TP compliance and reporting. And it was a difficult year because a lot of companies were not aware of the scope of transfer pricing or what transfer pricing compliance and documentation entails. At the same time, the regulations had come pretty close to the tax return filing deadline. So there wasn't enough time last year to plan and really work on these documents in a very ideal situation. Hence, with the second year and years going forward, it becomes very important to review and revisit the existing documentation. It's important to see what can be done to further strengthen the existing master file, local file, and enhance the evaluations and analysis presented in there. Now, when we talk about documentation, it's not restricted to master file and local file. It's important to also look at the supporting document that can further strengthen your TP analysis. So some examples of this is, ensuring you have formal service level agreements between related parties, or the group is setting up certain TP policies and documenting those TP policies, because these documents help strengthen the local file. They give more standing and backing to the analysis and discussion presented in the local file. The other thing that we look at is how can you enhance your analysis, your economic analysis or functional analysis. And another way to look at it is to see if there is any scope of doing some corroborative benchmarking analysis to further strengthen the standing of the taxpayer vis-a-vis the related party transactions. Now, when we look at compliance and documentation, of course, the next thing to look at is penalties. In our opinion, there is nothing in the tax law or the executive regulations or even the resolution to specify or to determine any penalty for delay in filing of master file and local file. Having said that, the Dariba system follows the same logic as it does for the tax return and does compute penalties for delay in filing master file and local file. Then it becomes important to focus on timely application of waiver of penalties. Now, last year we did see cases where there were waivers granted, provided the rest of the Dariba account for those taxpayers was clear. However, it could be that it was granted for the first year, so it could get difficult here on to claim waivers of penalties. So again, I would say it's important to work backwards. Now let's look at some international transfer pricing developments, and let's start with the EU public country by country reporting directive. So with this directive, the European Union has pushed the normal country by country reporting and emphasized more on tax transparency. So this directive is actually effective from December 2021, but the member states have been given time until June 2023 to transpose these directives into their local regulations. These directives apply not only to EU-based MNEs, but also MNEs that are not based in EU. So, but they have activities in EU member states. The threshold for these directives is 750 million euros, which is equivalent to 3 billion Qatari riyal, which is our threshold in Qatar for reporting country by country data. Now, what's different and what's special about this reporting is that it is going to be a separate reporting. This reporting will have to be done with the EU member states business register, which is already a public register. Plus, the group or the company will have to publish this data on the company website or the group website for at least 5 years. So all of this country by country style data is going to be publicly accessible to people at large, accessible to competitors. So that's why this is a little different than the normal country by country reporting and more transparent. Why this is important to us here sitting in Qatar? So all the large Qatar-based MNEs that would cross a country by country threshold and have operations in any of the EU member states will have to follow these directives. So they will have to keep an eye on the local legislations in those countries to see whether these will be effective for those countries. I'll move on now to the next international development, which is the LIBOR transition. I don't know if you're aware that as on December 2021, LIBOR has ceased to exist. Now, LIBOR is a very popular reference rate when it comes to setting up interest rates and is being used widely in a lot of loan agreements. So it becomes important to go back and look at your intergroup agreements or intercompany agreements and see if they're based on LIBOR. Because if they are, then today those agreements have no standing and that interest rate has no meaning. So it's important that you look for alternative reference rates, and these could be selected based on the jurisdiction with which you have these loan agreements. And it's also then a good opportunity to have a holistic view and a review of your existing loan agreements to see whether the terms and conditions, the term of the loan itself, the basis of the interest rates, whether all of that meet the arm's length principles. And to also then see if there's a scope to do some kind of benchmarking to ensure that there is no risk on tax adjustments. With this, I'll just sum up my discussion on transfer pricing today with 4 R's. The first one is review and revisit your existing documentation. Secondly, see how you can make it more robust by enhancing your supporting documentation. Thirdly, see whether your existing documentation is even relevant, keeping in perspective the market conditions as well as the business realities and the transactions between the related parties. And the fourth one is keep an eye on reporting, not just local, but also global reporting. With that, I'll hand over to Nurlan to take us through the VAT session today. And let's see whether he has an answer for the $1 million question. Is VAT going to be introduced in Qatar? Thank you all. Over to you, Nurlan.
Thank you, Uma. Thanks for your question, and thanks for the updates about the TIP transfer pricing. So as of now, Qatar is officially silent with regards to VAT. As of now, we haven't seen any official movement. However, we saw some actions or movement in the second half of 2021, where some financial institutions like banks, insurance companies, were asked to provide a VAT impact assessment report to the respective authority. And also we have seen some businesses from the different non-financial sectors being reached out and asked for the information about the VAT and how VAT will affect their businesses. So with that, we can see that the respective authority in Qatar is looking to understand how VAT will impact the overall economy and the businesses in the market. And also, additionally, the GTA president last year in his interview with the local newspaper mentioned that Qatar has no reservation about the VAT, and Qatar is part of the GCC VAT framework agreement, which was signed in 2016. So, and right now the matter is still under the legislation. What is our expectation as KPMG? We are expecting to see the VAT load during this year with the go live date either beginning or the mid of the next year. So this is the overall update about the Qatar VAT and our expectations. So with that, I want to just recap the history of VAT in the region, and let's just see which ways and the steps the VAT moved during these last 6 years. So as we know, in 2016, the GCA VAT Framework Agreement was signed by all member states, and the KSA, the UAE, were the first ones who implemented VAT in the region. And afterwards, Bahrain continued and then implemented VAT in 2019. And also we saw Oman implemented the VAT in 2021. With that, we have 4 member states in the region who implemented VAT. Also, even we have the VAT rate increase. We saw the first VAT rate increase in the region from KSA in 2020, from 5% to 15%. And also we saw the same action from the Bahrain, which started this year from 5% to 10%. As of now in the region, we do have 3 VAT rates, which is 5%, 10%, as well as the 15%. So the question usually we do receive from our clients, how many months or how many, let's say, which period do we need to have full and compliant VAT system before the go live date of VAT? In order to answer this question, I would like to just show the timeline between the announcement of the VAT law or executive regulation and the go live date. If we look at the history and the experience of KSA, UAE, Bahrain, and Oman, we can see that those businesses in that country, in those member states, were given around 3 to 6 months in order to complete everything and start the VAT. So actually, this month, the 3 to 6 months is not well enough for the businesses to make full preparation. We saw the experiences, challenges, difficulties of the businesses in the countries And at least the companies will need around 6 to 9 months in order to make all these preparations. If you look at the scope of the VAT and how it will affect, so it's a pure change management, like I can explain in the next slides. So the VAT will affect all supply chain of the company, of the business. So therefore, the company should have proper change management in order to be successful in this journey. So therefore, the business should understand in which areas, when the VAT will affect us. So what should be reviewed? Which documents should be checked? What kind of system configurations should be made? Which stakeholders should be informed? When we have to go to our customers with regards to new amendments and the clauses of our contracts or engagement letters. So therefore, the first step of the process is understanding of these change needs. Once we have the understanding list of the changes, so it will be easy to make a proper planning. So usually this understanding, making impact assessment, it takes around 4 to 6 weeks or 6 to 8 weeks. It depends on the size of the business and size of the transactions of the big company. And once we have all changes, listed changes, we can make a proper planning, and with the planning, the action plan, the company can go to the implementation. Usually implementation happens, like we can give an example from other VAT implemented countries, it happens after the announcement of the VAT law, because the actual implementation should be done based on the VAT law, and even if it is possible, if it is visible and announced, the requirements of the executive regulation. So with that, company will be able to make itself ready for the VAT before the go live date. And the last one is the communication. The changes should be communicated. All the stakeholders should be informed about the made changes and the effect of the VAT. Starting from suppliers, customers, internal team, external team, everyone should be informed, because VAT will affect all departments of the company. So HR team, IT team, procurement, sales team have to have this information, how VAT will affect in their specific areas. So once we have the full communication and the communication already completed, then the company can say we are at least 90%, 95% ready for VAT. After go live date of VAT, we will see what kind of challenges do we have. So this is with that, I would like to give a key message. So the first is timeline, which is 6 to 9 months. So therefore, it's better to start impact assessment as soon as possible before the announcement of VAT. And also, we know that from the experience of other countries, it will be difficult for the businesses to find a proper advisory company in order to support them. So in order to have the smooth and proper costly impact assessment and implementation, it's better to start the journey of VAT. With that, I would like to conclude my session and hand over to my colleagues Abhishek and Anand about the ESR and the BEPS too. Over to you, Abhishek.
Thank you, Roland, for the update on VAT, and we hope that the tax authorities would give sufficient time to the taxpayer before implementing VAT in Qatar. Good morning, everyone. First of all, I would like to thank you all for attending our KPMG Annual Tax Summit. I would be presenting on the economic substance requirement, which is the latest regulations issued by the General Tax Authorities related to BEPS 1. Before we move on, I just would like to give you a quick background just to understand the reasons for issuance of these regulations. As you may be aware that the Qatar is a part of the OECD Inclusive Framework on BEPS, which currently has more than 135 nations that have all committed to implementing the BEPS minimum standards to tackle the tax avoidance and increase the tax transparency. As part of this commitment, the Qatar has issued the economic substance regulations on 17th of October to address the preferential tax regime issues identified in Qatar as per the BEPS Action 5. The issuance of these regulations brings Qatar in line with the other tax jurisdictions which have already issued and implemented the ESR, such as Cayman Island, Bermuda, and United Arab Emirates. Now let's talk about the applicability of ESR. As per the regulations that these are applies on the entities that carry out covered service activities and intellectual property activities, and also benefiting from a preferential tax regime in Qatar. The regulations have clearly defined the term preferential tax regime is any tax regime that offers a tax preference compared to the general principle of the taxation in a country, or rather in a state of Qatar, which is regardless of the form and amount of the preference. Now let's move on the what are the covered service activities. As per the regulations, that any entity in Qatar conducts one or more following activities are subject to the ESR regulations. You may wonder that why these activities are included in as covered service activities, because that these activities are very easily can be shifted from one location to another in order to benefit from preferential tax regime. So the covered service activities includes the leasing, the fund management, holding companies, distribution and service centers, financing, intellectual property business, banking activity, shipping, headquarters, and insurance activities. Now let's look at what are the ESR requirements in Qatar. So as per the ESR regulations, the regulations require the entities who undertaking these activities and also earning income from these activities must perform the related core income generating activities in Qatar, which is by demonstrating that they have the appropriate number of full-time employees with necessary qualification to perform these activities. They have incurred appropriate amount of operational expenses to carry out these activities, and also fulfill the other requirements which is determined by the respective licensing authority in which they operate, in coordination with the general tax authorities. So that the licensing authorities could be the state, the QS, the Qatar Science and Technology Park, Qatar Financial Center, or Qatar Free Zone authorities. I also would like to mention here that the ESR requirements differ and also depend on the relevant activities carried out by an entity in Qatar. Now let's look at what are the transitional provision and compliance requirements. As of now, the regulations are silent on the compliance or the notification deadlines, and also on the penalties for non-compliance with the ESR requirement. However, they have provided the transitional provisions in the law, which allows the existing as well as new entities to comply with these regulations. So they have basically categorized into 3 different categories. The first is the existing entities which incorporated prior to 1st November 2020, and with no new activity started post 1st November 2020. When I say the activity, means the activities which I just talked about. These entities, they have a transitional period until 31st December 2023 to comply with the ESR requirements. The second is the entities incorporated prior to 1st November 2020, but started a new activity post 1st November 2020. They need to comply with these rules and requirements with immediate effect, only for the new activities which was started post 1st November 2020. The third is the entities which incorporated post 1st November 2020. They need to comply with these regulations with immediate effect. Although the Qatar has not yet clarified the reporting mechanism for ESR, however, I mean, based on our understanding, the reporting would be either by way of a notification, or it would be included as part of your tax, as part of our tax return, which we have already seen in the QFC, where you have the QFC is requesting the taxpayers to confirm whether they have the core income generating activities in Qatar, whether do they have the proper employees in Qatar providing those activities, or whether these activities have been outsourced to a related party or to a third party in Qatar. So which is, although it's not clear, but this is what our expectation. and also that the Qatar has not yet been communicated the consequences of non-compliance, whether there would be any penalties and what would be the tax, what would be the deadline to submit or to provide to submit the notification or any sort of filing. However, based on our experience in other countries, those who have implemented ESR already, the consequences could be penalties or even the loss of preferential tax treatment. Even if an entity is enjoying in preferential tax treatment, there is a possibility that that could be revoked by the respective authority, or even suspension of the entity's trade license. Therefore, it is of paramount importance that the entities in Qatar who undertaking these activities and generating income, they should assess whether and which of their activities fall within the scope of ESR regulations, and how to ensure that they meet the economic substance requirement in respect of each relevant activities, as I already highlighted those activities. This is all I have from ESR perspective, and obviously we will keep you updated once we have more updates and a clear guidance on the compliance requirement and the potential penalties for non-compliance. However, the message I would like to pass on is that I think as of now it is the right time to look at your activities and also to in which industry you are operating, and to ensure that you comply with the ESR requirement. At least you have these something to support what are the requirements before the tax authorities they come up with the filing deadlines or some other requirements to comply with this. With this, I will hand over to my colleague Anand, who will take you through the BEPS 2. Thank you very much.
Thank you, Abhishek, and thank you everyone for attending today's session. What I will try to do today in these next few slides is to give you an overview of what BEPS 2.0 is, and maybe make you familiarized with some of the key concepts. And obviously there are a lot of rules and modalities that are still expected to be thrashed out within the inclusive framework over the course of 2022. And we will keep you updated of these developments, and if required, do a separate session on these topics at a future date once the rules are out there. So just to set the context, why BEPS 2.0? So if you recollect, the OECD's work in the first phase, the BEPS 1.0, culminated eventually in the 2015 final reports, where a lot of the 15 action reports tackled a lot of BEPS challenges. But one of the areas that was not really agreed upon was basically the tax challenges that arise from the digitalization of the economy. The main reasons that were highlighted in the Action 1 report regarding the key concerns was that there was scale without mass. There were new elements that got more importance, like data and user participation, which gave value to the markets rather than the rest of jurisdictions. And there was a lot of mobility in intangibles. So basically the rules of taxation and their governance did not keep up with the changing business models, which caused a lot of BEPS concerns. In reaction to this, a lot of countries came up with a lot of their unilateral actions, basically something like digital services tax, resulting in double taxation, trade tensions, and a lot of other disputes. So therefore, the inclusive framework countries were decided, or in 2019, the OECD's embarked on this work in order to tackle the challenges that are arising from the digitalization of the economy. What needs to be understood here is that these issues are most evident in the highly digitalized businesses, which have virtual presence and not really physical presence in many places. But now these implications under BEPS 2.0, it will not be limited only to those businesses. So if we move on to the next slide, basically the inclusive framework agreed upon a two-pillar approach, pillar 1 and pillar 2. Pillar 1 is basically an agreement which is a significant departure from the existing standard international rules, and to some extent a departure from the existing transfer pricing rules, where the market jurisdictions will get a right to tax even in the absence of physical presence in those countries. Pillar 1 is now expected to apply to multinational groups that have more than euro 20 billion consolidated global turnover and a profitability above 10%. This threshold is expected to come down subsequently to euro 10 billion over a period of 7 years, subject to successful implementation now and a review period. It's expected that about 100 global groups are likely to be in scope. And what we're talking about right now is basically the amount a profit allocation, which is expected to be 25% of profits above a 10% profit margin. On the other hand, Pillar 2, it tries to level the playing field, to reduce harmful tax competition between countries, and it's looking to subject multinational groups around the world to a global minimum tax of at least 15%. This tax rate will have to be evaluated at the jurisdiction level, and you'll have to take into consideration the various modalities that the rules have set out. Mind you that the commentary and a lot of the other aspects are still to be finalized, which are expected towards the end of March and so. Basically, the idea is that a top-up tax will need to be calculated and paid in the head office jurisdiction. Separately, there is also a rule that is expected to apply on specific cross-border payments, where the recipient jurisdiction does not tax at least a 9% rate on those incomes. So Pillar 2 will basically apply on multinational groups where the consolidated revenue is at least euro 750 million, which is in line with the existing CBCR rules. Pillar 2 also allows jurisdictions to apply a lower threshold if required, and the basic criteria is that even if a country does not apply these rules, it will have to respect the right of the other country to apply and collect its taxes. So what are the key components of these two pillars, Pillar 1 and Pillar 2? I will not like to dwell too much on Pillar 1 because basically there's a lot of exclusions with regard to the extractives, oil and gas, mining industry, etc., and the regulated financial services, which will keep most of the large Qatari businesses out of scope. And the high threshold of euro 10 billion will also keep most countries out of scope. Also, the taxing rights for a country will depend upon a revenue threshold of euro 1 million, which is derived from such country. And it's reduced to euro 250,000 if the GDP of that country is below euro 40 billion. So therefore, the collections that might be expected for most countries under Pillar 1 will probably be minimal. So the key aspect is also that a lot of the countries which have implemented the digital services tax will have to roll them back in order to apply the Pillar 1 rules. Under Pillar 2, basically, like I mentioned, it introduces 4 new rules that would together provide the jurisdictions with additional taxing rights, where the other country has not exercised its primary taxing right. The threshold is euro 750 million, and the countries may lower the revenue threshold in respect of groups headquartered in their country. Once again, the requirement here is that even if a country does not adopt these rules, it must respect the application of these rules by other countries. Jurisdictionally, the effective tax rate is expected to be 15%, and there are some provisions for jurisdictional blending where there is more than one entity in that country. The subject to tax rule is expected to be applied in the form of a multilateral instrument similar to the BEPS 1. Its scope and how it will be implemented and the design of the MLI is expected shortly, and it will be up for public consultation. So what are these 4 rules that we're talking about? If we move on, if you see on your left side of the screen, basically the income inclusion rule and the undertax payment rule are the new taxing rights, which together are called commonly as the GLOBE rules. So the income inclusion rule applies in a fashion similar to the controlled foreign corporation or the CFC rules that many advanced jurisdictions have, which basically allows additional top-up tax in a parent jurisdiction if the income of the foreign branch or the controlled entity is subject to an effective tax rate less than 15%. It will apply in priority to the undertax payment rule, and the UTPR is basically a backstop to the IRR. And in cases where the IRR does not apply, the UTPR will come into picture. So basically, the UTPR allows a denial of deduction or impute other taxes on any income which is not already subject to the IRR. Coming to the right hand side, basically these subject to tax rule and switchover rule apply in conjunction to the existing treaties, and the STTR is going to be a standalone rule and it will apply independently and in priority to the IRR or the UTPR. So the STTR will be applicable only on certain specified payments, and it will apply where the recipient jurisdiction is not subject to tax to of at least 9%. Interestingly, over here, UAE which has recently announced its corporate tax rate, apart from being competitive, it is also the 9% is also the minimum threshold for the SCTR to kick in. The switchover rule allows countries to move from an exemption method to a credit method in order to tax foreign PE income in their jurisdiction to bring it up to a certain minimum tax level. If we move on to so this is the core component of the effective tax rate or the IRR, the calculation of the top-up tax. So basically, it has to take into consideration the taxes paid and the profit in a particular country. So the covered taxes and the GLOBE income both have certain adjustments that require to be made. There's also the model commentary that is expected to come out shortly. And there are certain inclusions and exclusions that need to be made to the covered taxes and the GLOBE income. And when you divide them, you will arrive at the effective tax rate of that jurisdiction. Please note here that the effective tax rate is different from your headline tax rate because of a lot of adjustments that you might make in your domestic, as per your domestic tax rules, your effective tax rate might fall below your headline tax rate. In the profits or the GLOBE income, there is a provision for a substance carve out for payroll costs and for tangible assets, which is eventually expected to settle at 5% over a period of 10 years. This excess profit after the substance carve out is the profit that will be subject to the top-up tax. The top-up tax is basically the 15% minimum agreed rate minus the effective tax rate in that jurisdiction, and therefore you'll arrive at your top-up tax rate. Now, there is also a provision which allows countries to impose a qualified domestic minimum top-up tax, which can potentially absorb the top-up tax. So therefore, where the net impact is zero, then there is no additional tax that might be required to be paid. On the other hand, where you do not apply the domestic minimum top-up tax, you will have to pay the jurisdictional top-up tax in your parent country jurisdiction. If we move on. So what are the key implications of Pillar 1 and Pillar 2 on Qatar? How does it impact the businesses here? So as I mentioned earlier, the threshold for Pillar 1 is very high right now. It's euro 20 billion. That's approximately about 83 billion Qatari dollars. So you do not have many companies which are exceeding the threshold, especially when you consider the exclusions for the extractive industry and the regulated financial industry. Additionally, again, like I mentioned earlier, Qatar being a fairly small market, the additional tax collections that would be allocated, the amount of profits that could be allocated to Qatar may be very minimal. On the other hand, Pillar 2 can have a lot of implications for Qatari businesses. One of them being the STTR, where you have related parties and operations outside Qatar, say for example in the EU nations, you might be caught by the STTR, which will lead to denial of existing treaty benefits or reduced rates, and also apply a withholding in those source countries. So the key questions here is whether Qatar will look to adopt any changes. Some of them being whether it will remove the exemption for Qatari nationals. This will automatically increase your effective tax rate in many cases, and whether it will also apply or introduce a qualified minimum domestic top-up tax. Similarly, there is also the chance that Qatar may increase its overall headline rate itself to the 15% minimum percent. Now, these rules there's no announcement from Qatar on these aspects as yet, and we'll have to wait and watch how things develop over 2022. Notably, also the IRR is expected to come into force from 1st January 23, so there can be a lot of movement throughout this year. I would like to move on to some examples now, a simple form just to show how these concepts will work. So this first one is relating to the subject to tax rule. So here jurisdiction A, C, and D are basically related parties. Jurisdiction A is considered a low tax rate jurisdiction, which has a nominal rate of just 5%. Therefore, jurisdiction C and D have the right to apply the STTR, which can be in the form of denial of treaty benefits or additional withholding taxes on specified payments to jurisdiction A. If we move on to the income inclusion rule, again, this is a fairly simplified example just to understand how the concept will work. Here, jurisdiction C and D are the source country jurisdictions, and here are constituent entities. Jurisdiction C is assumed to be a low tax jurisdiction which applies a rate which is below the 15% or no tax at all, whereas jurisdiction D is considered a high tax jurisdiction above the specified 15%. Therefore, D will be out of scope, and it's only C on which the IRR will be applicable. So now two scenarios can play out here. For example, if Qatar applies the IRR or if it does not apply the IRR. If it does apply the IRR, then it can collect additional taxes in respect of income for jurisdiction C to bring the effective tax rate up to the 15%. Conversely, if Qatar does not adopt the globe rules or the IRR, it will cede its taxing rights to, say, for example, Netherlands, which is the intermediate parent holding company. And if they adopt the IRR, they can collect the additional taxing rights in tax in respect of jurisdiction C. These are, mind you, fairly simplified examples, and it's just to convey the idea of how these rules are expected to apply. With that, I would like to conclude the session. Thank you for your patient listening, and we are open to any questions that you might have.
Indeed, a lot of questions. So maybe I will just ask the first one to Imran. The question is on technical services rendered within Oman, whether there will be no longer subject to withholding tax, or whether withholding tax will still apply on them.
So if, for example, Qatari company is providing services of technical nature to, say, Omani company, in the past, those services would have been subject to withholding tax at the rate of 10%. Now, under the treaty, there is a relief, but it is full relief. There will be a partial relief, and the services will be subject to withholding tax at the rate of 8%. However, if it would have been in the opposite direction, since Qatar has a 5% rate, domestic rate, So the withholding tax rate if the payment is being made from Qatari company to an Omani company, then the rate of withholding will remain 5%. So there could be a relief for Qatari companies, but Qatar has already a lower rate. So as such, the domestic rate will apply if Qatari company is making payment to Omani company.
Okay, thank you, Imran. The next question, I think it's addressed to Uma. Is there a possibility of extension for transfer pricing? I think for transfer pricing filings, and how can I apply? Uma, I think you're on mute.
Sorry, my apologies. So this year, I think there's, like we said, that it's highly unlikely that there will be an absolute extension. Again, when it comes to the law, there is no specific provision on how to specifically apply for extension of filing, say master file, local file. So the only thing then here is that either you could follow the same timelines that are granted for a tax return extension request, which would be end of February, to seek additional extension for the filing of the master file, local file, or follow the same principles, which is 60 days prior to the deadline. So given that there is no regulation or no provisions on this, the only thing is then you strengthen probably your defense if you at least apply for an extension if you already foresee that you will not be able to meet the deadline. I hope that answers the question.
Thank you, Man. The next goes to Anand. So does BEPS 2.0 means that Qatar will increase the tax rate to 15%?
That's an interesting question, Barbara, but we do not know what will happen. Because of the qualified domestic minimum tax, which Qatar can apply in line with the globe rules, they need not really increase the headline tax rate for all the companies. It can also apply these rules only to certain specified companies, which is basically above the threshold. So it need not really increase the headline tax rate for everyone.
What does it mean for the Qatari exemption?
Again, we have to wait and watch to see how it might impact, because a lot of the Qatari companies, the Qatari exemptions will, bring, if you remove the exemption, it'll automatically bring up the effective tax rate for a lot of companies, not only the purely Qatari companies. And it might also have some relief in terms of how SCTR and some of the other rules apply. So it's from Qatar perspective, it's a bit of wait and watch right now.
Thank you very much, Anand. The next question goes to Nurlan, I would say. You mentioned that companies in general need between 6 and 9 months to implement VAT. Why is it so long? Because there was our own experience with implementation of a corporate income tax a couple of years ago. It took us less time. So why 6 months or longer?
Yeah, it's a good question. Thanks, Barbara. So because it's VAT change is not just a role of the finance or the reporting team. As I mentioned earlier, VAT will affect all the areas of the business. So therefore, it takes time, like having discussion with the procurement team, sales team, marketing team, HR, IT. So therefore, it takes time. And having this discussion, making the proper understanding VAT, in which areas VAT will have an impact. So therefore, it will take time. So therefore, the short time will not be enough for the businesses to make the readiness actions.
Thank you, Nurlan. The next question is, how do you solve the issue? Sorry, it was just moving away. How do you solve the issue for contract reporting? Let me see. If the signing date is after the go live date. Maybe I can take this one. So this is indeed a problem because the RIBA will not allow you to have different dates. So signing and starting date of the contract in the system needs to be to do the same. So what I would recommend is a practical solution. So there is no correct way if those differ, but is to report earlier if possible. So if you know that the contract will come into force, you already submit or file it at this date, because there are no consequences if you file a contract too early, but they are if you file too late. So that's what I would suggest. But unfortunately, there is no real solution for that. There is another question, I think. Let me check. I think it's for Uma. Public CBCR. Does this really mean that we as a Qatari company will have to publish our figures on the website of our Dutch subsidiary?
Yes. So public CBCR, of course, will apply only to the large MNEs. So the ones that are headquartered in Qatar and having, like in this example, that you have a Dutch subsidiary. So yes, you will have to submit or publish information. And it is not just about the subsidiary, I would say. It is the overall group, information, a very CBCR style information, but it needs to be broken down for entities that are there in the member states. So in your case, the Dutch subsidiary. So that will have to be broken down. And also information about entities that are in the Annexure 1, Annexure 2, that is the blacklist and grey list of EU, will also have to be broken down. And maybe in that case, even Qatar information will have to be broken down when you publish the CBCR data on your website or with the business registers.
Thank you, Uma. The next is, I think, an interesting one, and I think it will affect a lot of among you. It goes to Imran. My Deriva account shows penalties which are not correct. What can I do?
So first of all, that is quite a common issue that in many cases we have seen when the transition happened from old TAS account to Deriva. There were many kind of probably errors, etc., which remain there or stayed there. So one in the past, some companies were kind of when it was in TAS, the error were there. The companies were not taking action, but it should not be the case in Deriva. The companies should seriously look into those issues one by one and see that from where those issues are coming, and have a consultation either through email. You can communicate to the for example, the Deriva team, that these are the issues. For example, the payment is already being made, it was made on time, etc. So the penalties should not appear. So these issues should be resolved. Otherwise, if you are going to request, for example, now companies might be considering requesting for an extension. If there are already penalties being shown in Deriva, you may not be even able to request an extension. So there could be a lot of complications involved if those issues are not sorted out. So our recommendation would be we highly recommend to look into those issues very carefully, see where is the root cause, and try to sort it out with providing the sufficient document to the GTA, so that those can be resolved. Otherwise, you might face a problem later on, maybe after a few years or few months, few days. So that's it.
So basically, it's not a good strategy to just wait until those penalties disappear from themselves again, right?
Yes, exactly. You have to take action, because otherwise it might affect you in other ways. So yeah, there are various actions which the GTA is restricting if the penalties are being shown.
Thank you very much, Imran. I think there is one further question for you. Sorry, I just could you please confirm that for wholly Qatari-owned companies and even simplified tax return, the deadline will be the 30th of April?
Yeah. Thank you. That's very good question, because last year, okay, what we have seen that the deadline was for foreign companies was extended to 30th June. And even for whereas for Qatari companies and for simplified tax return, the GTA extended even to 31st December 2021. However, the official deadline for all the companies, regardless of whether they are Qatari, they are simplified, or they are foreign companies, is one deadline, which is within 4 months of the year end. So the deadline so far for all companies, including Qataris and simplified return, is 30th April 2022. Therefore, all the companies need to prepare. It is not only the foreign companies which are paying the taxes, but all the companies. So they need to be ready.
Thank you, Imran. There is one question for Abhishek on economic substance regulations in Qatar. Will these regulations apply to QSTP and free zone entity that are exempt from corporate income tax?
Hi, Barbara. I think that's a good question. Yeah, to answer is that yes, these regulations would apply on these the entities operating in the QSTP and the free zone. But we need to wait. We need to wait for the further clarification from the tax authorities. You know, the answer is yes. It applies to these entities, but obviously we need to wait for the clarification in terms of the compliance and how. I mean, basically, how to comply with these, how they can comply with these regulations.
Okay, thank you very much, Abhishek. There is one for Anand, a further one. I just disappeared again. Sorry, I just need to. Yes. What type of income will be included in Pillar 2 for effective tax rate calculation? And then there will be a second one. I just read them through. There are currently multiple double taxation treaty between the countries which cover CGT and withholding tax on interest and dividends. Will that also be affected by Pillar 2?
To answer the first question first, so basically the ETR calculation, the simple formula is cover taxes by your globe income in that jurisdiction, which will give you the effective tax rate for that jurisdiction. However, like I mentioned during the presentation, there are a lot of inclusions and exclusions that need to be adjusted before you can arrive at the cover tax and globe income for the purpose of these rules. Regarding the other question on the double tax treaties, so basically there are the scope of STTR. I'm assuming the question is regard to STTR. It will be impacted in terms of certain related party payments, including on interest, management fees, technical fees. The capital gains tax may not be affected. And we'll probably have to look out for further developments over there. And like I mentioned, the STTR applies independently of the IRR and UTPR. So even if someone escapes the STTR, they might still be caught under the other rules.
Thank you, Anand. One more question goes to Imran. Sorry, I have to jump a bit because the questions just keep on coming in. It's actually also two questions. One is on retention of documents. So how long do you need to store your documents in Qatar? And is there any mandatory form how you need to obtain? Is it original? Is it copies, or what do you have to do?
So the documents needs to be maintained for a period of 10 years. Ideally, the law requires you to keep the originals. So, however, in practice, we have seen that the companies, like now we are in a digital world, so there are often like digital copies, etc., of invoices being circulated. So, as such, often there may not be the so-called old traditional original document. But however, the law provides that the documents need to be retained for a period of 10 years. And if you are maintaining some documents electronically, you need to have certain conditions needs to be fulfilled. And after that, you can maintain the soft copies also. Otherwise, the general rule is the documents need to be maintained in physical form and for a period of 10 years.
Okay, and then there is a second question. A lot of our old tax returns do not appear on the RIBA. And we contacted the REBA team and the tax technical team, and they told us to file again through the REBA. But then, of course, penalties appear. So do you have a solution for that?
I believe that probably is not a sound advice which the GTA is giving you.
Yeah.
Definitely the penalties will kick in. So unless you are like, and then it will be difficult for you to kind of remove those penalties. So probably you need to look at your records, how those filings were being done, whether those were being done, for example, in the old tax system. If those were done in the tax system, provide those records to the General Tax Authority and ask them to transfer it. Or otherwise, like have a kind of a very clear discussion with the General Tax Authority or their IT team that there will be no penalties appearing. Otherwise, it could lead to huge penalties. So generally, by submitting it again, that's not the best way forward. You probably need to look at how your filing was done, and then provide those documents to the GTA and tell them that is kind of they should be doing it at their end rather than you should be doing it at your end, which will unnecessarily lead you to penalties.
Thank you. And it's quite a common scenario as well, right? That you don't see all. So we also have such cases.
Yeah. Also, there is this potential, that don't know that anyone really asks you to do it, because if these are not appearing in the REBA, and however it is somehow in the GTA record, that whether there is a kind of a necessity to kind of upload it, because often, it is not like 2015 for all companies will be filed. And usually what the GTA will do at the time of assessment, they will ask you to provide you a copy of the return which was filed and acknowledgement. So how this kind of arise, probably we need to understand. You need to discuss with your consultant that how this situation arise, why you are looking into it and why you want to refile it. If it is not appearing, the GTA can simply ask you at the time of assessment and you can provide them.
Thank you, Imran. Next question for Uma. When did LIBOR cease, and from when do we need to amend the agreements based on LIBOR? So the date.
Thank you for the question. So the LIBOR ceased to exist since end of 2021. So if you have an agreement based on LIBOR, you will have to renew it, even if it's an old agreement, even if it was signed prior to the to the timeline that LIBOR ceased to exist. You will have to renew those agreements because for the simple reason, typically it is when LIBOR is used as a reference rate, it is LIBOR plus some premium. Now, when the LIBOR has ceased to exist, you do not have any basis to compute your interest rate at all by the end of the year. So you would not know what is your effective interest rate for your next payment or your next booking of interest. So you will have to renew it as soon as possible, I would say, because as of today, there is no interest rate. Even from transfer pricing, if someone has to test the arm's length pricing, you cannot evaluate what is the effective interest rate at this stage. I hope that answers the question.
Thank you, Ma. Next one goes to Imran again. I think it's a short one. Is the use of software, app, or subscription here too for providers out of Qatar without the tax card in Qatar subject to 5% withholding tax?
That is okay. Probably can say that first is quite a debatable area. The second thing is that we probably need to see the actual transaction in detail. Whether it is kind of somehow licensed or you are purchased the software, so whether it can somehow fall under the services, etc., which are being rendered. So the pure on a other level, the pure purchase of software which is not customized should ideally be not subject to withholding tax. However, generally the tax authority is, and also under the new regulation, where there is no necessity that where the services are rendered, if there is a licensing which is being done of the software or other application, and you are paying for those subscription or a license fees, that usually will be subject to withholding tax. So, however, we strongly recommend that those agreements need to be reviewed in detail for concluding it whether it is or it will not be subject to withholding tax.
And I think it's important to also keep in mind that the starting point from the tax authorities will always be that those payments are subject to withholding tax, and then you just have to try to defend why not. And for some, we are indeed of the opinion that they should not be subject to. Yeah. The next one goes to Nurlan again. It's on the starting date of VAT. So is there any update when VAT will enter into force?
There is no official announcement or movement about the VAT, but we do expect that at least to have the draft VAT law officially during this year, but with the go live date of either the beginning of the next year or the mid of the next year. So this is our expectation.
Thank you, Nurlan. There is another question with respect to contract reporting. Okay, starts rendering the service. Okay, yeah, that's the same. It should, the problem is that the start date cannot, I think we answered this one. So, there is no technical right solution. If the start date is before the signing date, then you just need to try to report early. So I think that's then. The other is to public CBCR, Uma, it's to you. Is this a separate CBCR filing, or will just the current CBCR, the normal CBCR file used?
It will be separate because they have specifically identified 7 areas. It's not too different. When you look at the areas being reported are not too different from the existing CBCR, but the filing will be separate because they have to be filed with the EU member, any of the EU members' business register. So the mode of submission also is different. And then the publishing on the website. Also, the bifurcation requirements are different. So they want global information, but you could, for entities that are not EU based or which are not in the gray or blacklist, for those entities, you can even consolidate the information. So the form, in that perspective, the format may differ of how you present the data. And of course, the filing channel is different. So I would say it will be a separate filing.
There is just another question for you. Is there any update on the GTA's position on the transfer pricing, nil filing of local file and master file requirement for companies that do not have transactions with foreign related parties, but otherwise meet the requirement?
Yeah, there is no official update after the issuance of the FAQs. So here I would say, I think there's also one more question on that. So the way the resolution, the regulations, as well as the resolutions, as well as the FAQ, all of these, the way they are drafted is the focus is on the existence of the relationships. So do you have a foreign related party? Is there a foreign related, or do you have a related party abroad? These are the questions. So the focus for the trigger is on the existence of relationships. And if that answer to that is yes, then the way the law is drafted, you will have to submit a master file and a local file. If there are no foreign transactions, then that would have to be specified there. That is our opinion on that, yes.
Sorry, yes. Thank you. I think we have one more question to take, and then let me see. We will try to answer, the other questions which we were not able to. Do Qatar and the UAE currently have a double taxation treaty, Imran?
The short answer is no. There is no double tax treaty between Qatar and UAE. The only 2 treaties which I mentioned are within the GCC, the Saudi Arabia and the UAE. and now Qatar and Oman. There are, as per my knowledge, there are no other tax treaties between any GCC countries as of now. But we will continue to see this trend further expanding for what issues I highlighted, because basically the GCC Treaty of 1989 does not resolve the issue of double taxation. So it is necessary that now the GCC countries will enter into more treaties with each other.
Okay. Thank you, Imran. I think there is the last question goes to Abhishek. For ESR entities, what does new activity after November 2020 mean, or 2021 mean? I think you're on mute.
Sorry, Barbara.
Yeah.
Can you please repeat the question?
What does for ESR and what does new activity after November mean? What kind of new activity could you bring into scope?
Yeah, so when I say that we say the new activities means the activities out of any out of the 9 or 10 activities which I have explained. If you start any of those activities after 1st November, that would fall under the ambit of the ESR regulations.
Yes, and of course, if those activities benefit from a referential tax treatment,
benefiting, you are generating income from those activities and at the same time benefiting from a preferential tax regime. Correct.
Okay, thank you very much, Abhishek. So with that, we are at the end of our session. So I would like to thank all of you for the questions. It was really interactive, and I had a hard time to try to catch all the questions. I really liked it. I also would like to apologize for the noises. We hope that the next time we will get this under control. Thanks for staying and looking forward to our next webinar. Thank you. Bye.